video, we're going to talk to you about estate planning. So estate planning is something that people often leave till much later on in life. The downside of doing that is that it may be too late to make use of some of the potential planning tools that can help you reduce the amount of inheritance tax that is payable upon your death. The first step in ensuring that your wishes are fulfilled is, of course, to make a will. Today we're going to focus more on how to protect your estate and ensure that more of it passes directly to your family.
So we'll take a start now by looking at the available allowances. So currently the inheritance tax nil rate band stands at £325,000. That means that if your assets are worth less than £325,000, then you should have no tax to pay. In 2017, the government also introduced a residence nil rate band, which currently stands at £175,000. To be able to utilise this additional allowance, you must pass your main property or main residence to a direct descendant. So that might be children, grandchildren, stepchildren, or even adopted children.
Now, as with most taxation, it does get a little bit more complicated than that, and there are some tapering rules that are for larger value estates. But in simple terms, you could benefit from allowances of up to £500,000. For married couples that have not made use of the nil rate band, for example, where they have joint assets, then the allowances can be passed on. That means the surviving spouse will have an allowance of up to £1 million.
I recently had a client that told me he definitely didn't have assets worth £500,000 or more. However, when we started to add everything up, it quickly became apparent that actually he was one of many people who make this assumption. He'd purchased his home over 30 years ago for just less than £200,000. However, today's valuation was just shy of £400,000. In addition, he had other assets in ISAs, pensions, bonds, and property.
So what happens if your assets are above the nil rate band? Well, HMRC will tax you at 40%, so that's almost half. Estate planning becomes essential here in protecting your money. If your estate is subject to inheritance tax, the bill does have to be paid before your estate can be distributed. This can often mean that family members will have to take out an expensive loan to cover the tax bill. We're going to give you a brief summary of some of the potential estate planning tools that you can use, but it's important at this point to highlight this is for information purposes. You should receive your own financial advice to make sure that it's right for you.
So aside from the allowances we've just talked about, you do also have some additional protection for inheritance tax. Any money that's currently invested within a pension would fall outside of your estate for inheritance tax purposes, as does the proceeds for some qualifying life assurance policies. The same could be said for bonds. However, that does largely depend on the kind of bond and the features of your individual product.
So some of the other ways that you can protect your assets are to utilise the annual gift allowance or gifting from your regular income. Gifts above the annual allowances are what we call potentially exempt transfers and fall outside of your estate after 7 years.
You can also utilise trusts, and this can be a complex area, and it's really important to know your objective for this money early on. If there's a possibility that you might need to access this money in future years, then this might not be the right solution for you.
There is, of course, property ownership. So in our other presentation where we talked about paying for care, we did touch on the subject of changing the ownership of your property or passing your own share of the property down the line rather than passing between spouses. Again, it's complex and you can't just simply gift your home whilst you're still living there. Legal and financial advisors will be able to help you with the rules around this.
You can also insure against any liability. In the same way that you might take out insurance to cover your mortgage, you can also take out life assurance policies to pay any potential inheritance tax. It's very likely to be quite expensive, but it can be less expensive than the inheritance tax bill itself. Other planning tools are likely to be recommended first. However, this option is the correct route to go down for some of our clients.
And lastly, there's gifting to charity. So if you leave money to charity, it reduces your inheritance tax bill as these gifts are non-taxable. If you leave more than 10% of your estate to charity, then the remaining balance of your estate is taxed at a reduced rate of 30%. So it gives you a further saving on your estate.
So, the key takeaway from today's session really is start planning early. This will allow you to utilise your gift allowances over time and also make use of any potentially exempt transfers. Finding out what all your options are will allow you to make an informed choice early on. Your financial plan should be fluid, as allowances and, of course, your circumstances can and will change over time.
And remember, working with a professional, the cost of receiving the advice will far outweigh by the money that you could save.
Thank you.
Thank you.